The same thing that makes crypto assets or cryptocurrencies so alluring is what also makes them dangerous. These digital offerings are typically built without the need for a central bank, giving them an element of anonymity similar to cash transactions. This makes them a potential new vehicle for money laundering and terrorist financing. Cryptocurrency is a form of digital currency. Cryptocurrency is a form of digital currency that operates independently from central banks and other financial institutions. It relies on encryption techniques to secure transactions and regulate the creation of new units. This makes it difficult to counterfeit or double spend. It also offers anonymity, which is important for some criminal activities. It is also a fast, low-cost alternative to traditional payment methods. The popularity of cryptocurrency has grown as people seek alternatives to conventional online payment systems. However, this emerging market has a dark side that may surprise unsuspecting investors. Cryptocurrency is an attractive target for cyber criminals who use it for illicit activity, including ransomware attacks and money laundering. In addition, the lack of regulation in this space leaves investors vulnerable to scams and theft. While proponents see cryptocurrencies as a democratizing force that strips the power from Wall Street and central banks, critics point out that they are not transparent and can be used for illegal activities. In addition, they can be highly volatile and consume huge amounts of electricity to mine them. While some governments are embracing them, others are banning them or regulating them. Despite its unregulated status, the cryptocurrency industry has grown to be worth billions of dollars. Its popularity has prompted many to invest in it, even though there are risks associated with investing in this market. Cryptocurrency is not backed by any central bank or government, so its value is based on the trust and confidence of users. This can make it a dangerous investment, especially for inexperienced investors. Another concern with cryptocurrencies is their use by criminals and terrorists. Cryptocurrency is popular among these bad actors because it can be used anonymously, and it is easy to move around the world without being detected by authorities. Moreover, it can be used to hide assets and avoid taxes and legal restrictions. A recent report by Chainalysis found that illicit cryptocurrency transactions accounted for $10 billion in 2019. Lastly, the blockchain technology behind cryptocurrencies is complex and often difficult to understand. This can be problematic for regulators and law enforcement agencies who need to develop a clear understanding of the crypto space in order to effectively address the risks. It is decentralized. Cryptocurrencies are decentralized, meaning they lack the backing of a central authority. Instead, they use a technology called blockchain to verify transactions and prevent double spending. This process is done by a distributed network that includes people who run nodes, computers that store a copy of the blockchain. These nodes are spread across the globe, making it difficult for any single person or entity to control the cryptocurrency network. However, this decentralization comes with some drawbacks. For one, it can make it harder to resolve disputes or enforce regulations. In addition, it can lead to the development of a new vehicle for money laundering and terrorism financing. Because crypto asset transactions are often anonymous, they are easier to use for these purposes than traditional cash transactions. The crypto industry is largely unregulated, which makes it a magnet for scammers and fraudsters who target unsuspecting investors. For example, some of these fraudulent actors launch fake initial coin offerings, ICOs, to raise funds for their projects and then disappear with the money they have collected. This makes them a threat to the integrity of the crypto world. To avoid this, cryptocurrency enthusiasts are working to make the blockchain more secure. They are trying to increase the number of nodes in the crypto ecosystem and disperse them geographically as much as possible, so if one or more of these nodes go offline, it won't affect the rest of the system. Another way to improve security is by using the proof-of-work system, which distributes the work required to validate blockchain transactions among a large pool of mining entities. This system makes it nearly impossible to manipulate the blockchain by deleting or altering transaction data, and it provides an additional layer of protection against malicious attacks. While cryptocurrencies aren't fully decentralized, they are closer to it than most other financial systems. Some, such as Bitcoin, have a high level of decentralization and are therefore less vulnerable to attack. Others, such as Ethereum, are more centralized around their company, but the technology behind them is still highly decentralized. Another aspect of decentralization is physical decentralization, which involves physically distributing the blockchain servers as widely as possible throughout the world so that no single server will be affected by a disaster or power outage. It also means that the blockchain is unlikely to be compromised by a hacker, since a majority of the servers will continue to operate even if the company that owns them goes out of business. It is anonymous. Cryptocurrency has captured the attention of investors and tech enthusiasts worldwide. Its allure lies in its potential to offer increased security and transparency while allowing people to transact with each other. But this nascent industry is also prone to fraud, scams, and theft. This dark side is fueled by the allure of anonymity and the lack of regulation. Cryptocurrencies are often portrayed in movies and shows as being the ideal way to move money around anonymously for nefarious purposes, such as drug trafficking or tax evasion. Unfortunately, this is a myth. In fact, most cryptocurrencies, including Bitcoin, are not anonymous at all. Instead, they are pseudonymous, meaning that your name is replaced with a fake one, which isn't very effective at hiding you. Moreover, if you're smart enough to search the blockchain, it's possible to trace wallet addresses and link them to known users. This is why a robust cryptocurrency analysis and blockchain intelligence solution is essential for investors. Specialized technologies like quantum AI trading can help identify suspicious activity, preventing bad actors from using cryptocurrencies to fund their illegal activities. These solutions are crucial for ensuring the integrity of the ecosystem and safeguarding investors' investments. With these tools, investors can avoid falling prey to the many frauds and scams that abound in this volatile market. Ultimately, the key to success in this endeavor is to view these threats as obstacles to overcome rather than a reason to give up on the journey altogether. It is prone to fraud. Cryptocurrency is a powerful tool, but it's also prone to fraud. Its decentralized nature and lack of government regulation can make it easy for criminals to hide and operate undetected. While this may not be a concern for most investors, it's important to know how to recognize and avoid these scams and losses. The most common type of cryptocurrency scam involves social engineering and fraud to steal money or crypto assets from users. These scams target a person's humanity and trust instincts to get them to reveal key information or funds. They can be carried out by posing as government agencies, well-known businesses, tech support, community members, or even friends. They can take days, weeks, or even months to gain the victim's trust before demanding payment in crypto. Scammers can also use cryptocurrency mixers to launder stolen funds by transferring them to multiple exchanges. They can then use these mixers to convert the cryptocurrency into cash, which they can then spend or transfer to other accounts. This is especially dangerous for investors who are new to the market, as it's not always easy to tell whether a crypto transaction is legitimate or not. Another popular form of cryptocurrency fraud is a coin or token scam. These scams are created by criminals who impersonate a new or established business and promise high returns on investments. They then spread fake promotional materials or news articles to lure investors and steal their money. This type of fraud has been on the rise, with losses from cryptocurrency-related crime up 79% in 2021 compared to the year before, according to blockchain analytics firm Chainalysis. In other types of cryptocurrency fraud, criminals inflate the price of an asset through fraudulent or false information published in online communities and forums. Then, once the price reaches its peak, they quickly disappear with the money. This type of fraud is similar to stock market bubbles, and it can be especially dangerous for small investors. Unlike traditional investment opportunities, many crypto investments are made through private offerings which are exempt from federal and state investor protection laws.